the market's trying to stabilize. I mean, look, we had a pretty strong week for the Dow. Underneath, I'm a little worried. Investment bankers are coming back from their summer vacations. We're starting to see yet another wave of somewhat eagerly anticipated IPOs, depending on which one. I mean, you got Peloton, maybe Postmates, and of course, this the We company coming soon. But the thing about this stage of the IPO cycle is that you're starting to get lower and lower quality merchandise. That always happens. Sooner or later, the market will notice. And that's what happened yesterday morning when SmileDirectClub, SDC for you home gamers, came public. Now, this is a teledentistry company. Rather than going to an orthodontist over and over again to get braces, you can get a remote appointment on your computer. No in-person visits required. Then they'll sell you high-quality clear aligners, a lot like Invisalign, for less than half the cost of traditional braces. In other words, SDC is a disruptor in the field of orthodontics. So many investors and commentators believe that it would be a good deal, and instead, it flopped. Now, don't get me wrong. I always thought SmileDirectClub had potential. At least I did until I saw where the IPO price, which is at $23, was above its proposed range, which was already pretty aggressive. Once I saw that, I figured it might struggle. And I said so on Squawk on the Street. But even I, as negative as I got on this thing, did not expect it just to completely tumble and melt down. In case you missed it, SDC priced at $23 and then immediately began trading at just $20.55. Think about all the loss. That's an instant 10% loss for anyone who got a piece of the deal. It only got worse from there, with the stock sliding to $16.67 at yesterday's close. Ouch. Okay, the stock rebounded today up 12% to 18 and change. It's still down substantially, though, from both the deal price and the first trade. That's a pretty demoralizing start for SmileDirectClub. So we need to ask ourselves, was this breakdown right? Or just did the underwriters botch the pricing? So let's take a closer look, because there's a lot to learn from this escapade. I haven't touched on enough of these IPOs. They're very exciting, and you get one, and then you forget about it. First off, SmileDirectClub really does have a cool concept. I know it sounds a lot like Align Technology with its clear, removable retainers, and that's because it is like it. However, there's some key differences. Without insurance, Invisalign's product goes for $3,000 to $5,000. SDC's costs roughly $2,000. Even more important, if you want to get Invisalign, you have to go to an actual orthodontist and get monthly checkups. SDC lets you take your teeth impressions at home via a kit, although you have physical locations where you can get it done professionally. You can check in with the dentist via teleconferencing. Now, that's a lot more convenient, isn't it? SDC also recently rolled out nighttime aligners. You wear them for 10 hours at night. For whatever reason, you can't wear the normal ones during the day. Now, I think this story is practically custom-tailored for millennials who want to look their selfie best at all times. SDC is a bargain. It's convenient, and it makes you look better on Instagram. That's the trifecta. That's the story. How about the numbers? In the first 6 months of the year, SDC had spectacular 113% revenue growth. The gross margin, what they make after the cost of goods sold, increased by 1,200 basis points to 77.6%. Their earnings for interest, taxes, depreciation, and amortization just barely turned positive at $2.3 million. What's eating up so much of their money? Marketing expenses. In fact, SDC's marketing expenses grew faster than their sales, up 141% year over year to $209 million. Not what I like to see. So let's go over the pros and cons. On the plus side, what do we have? All right, we've got truly turbocharged growth. While their sales growth decelerated from 190% last year, 113% in the first 6 months of this year. Come on, that's pretty darn good. Not many companies can boast of that kind of number. Their average selling prices are going up. Always a good sign. And the opposite of what we've seen from Align Technology, which has had its stock eviscerated over the past year because of competitors like SDC arriving on the scene. I also like that the company's trended toward profitability, even if it's not quite there yet in any substance. Those are the pros. How about the cons? First and foremost, there's that marketing cost number. Ideally, you want your revenue growth to exceed your marketing and selling expenses. With SmileDirect, it's the other way around. Hopefully, they can tap the brakes on promotional activity once they've reached a critical mass level, but we'll have to see. Second, I am always a touch suspicious whenever I see a company with a big in-house financing arm, because in the past, we've seen cases where easy financing masked weak demand for the product in question. This hasn't happened here, but I always think about it. It's in the back of my mind. That's a lot more pros than cons. So why did the IPO turn into such a disaster for anyone who had the misfortune to get in on the deal or maybe buy the stock at the opening? I think a lot of it comes down to the pricing. $23 was simply too high. Even at $18 and change, where the stock is right now, it's too high. Because SDC tells it for 8.5 times this year's back-of-the-envelope sales forecast. That's very expensive for this industry. Align Technology sells for roughly 6 times sales. Remember, SmileDirectClub isn't some kind of cloud-based software company. It doesn't have some sort of fantastic recurring revenue business model. It's basically in the same business as Align. Although, given that Align is actually profitable, it's not quite fair to compare the price to sales multiples. On the other hand, SEC is growing much faster. But this is now a market that suddenly values profitability a lot more than growth, and that's crucial. It's not just valuation, though. At the end of the day, the key comparison here is Align Technology. And Align stock has been a total disaster of late, because it had a very big run, of late, because the invisible tooth aligner business has gotten increasingly competitive. Investors hate competition. When Align had the industry to itself, it was a great stock. But now you've got SDC coming in. 3M has been trying to make this move, not to mention an outfit called Strowman, and then Dentsply Sirona. Frankly, it's starting to feel a little crowded. Like, you know what it does? It feels like the online food delivery space where Grubhub used to be the great investment, but it became a real dog once others started moving in on their territory, which is why it's very hard to recommend.
Don't buy, don't buy,
Bottom
don't
line,
buy.
I think the underwriters priced the SmileDirectClub deal far, far too aggressively. Totally misjudged the demand. Something that starts happening, by the way, near the end of an IPO cycle like we've had, not the beginning. But honestly, maybe this just isn't a great time for IPOs of companies with terrific revenue growth and no profits that operate in increasingly competitive industries. I don't know what the right price is for SDC, but I do know I wouldn't pay more than $16 and change for it, exactly where the stock bottomed just yesterday. Mike in Florida. Mike.
Jim, it's great talking to you.
Same.
I'd like to ask you a question about the stock of Real. You mentioned the stock a couple of weeks ago, and I agree, their business concept certainly is excellent. But on August 30th, 2 law firms put out shareholder alerts on the stock. And this was related to their IPO, and the firms are investigating potential violations of the security laws. But what's interesting, it seems to be having absolutely no impact on the stock, because since August 30th, Real has had 9 straight up sessions. My question, should I add to my holdings in Real?
I like Real very much. By the way, my wife just used Real this week and just loved it. We've liked this stock. We think it's a terrific situation. But, you know, when we were talking to Everlane, they like it. So I think that Real is the deal, and I would really recommend you buy some more Real. All right, listen up. I thought SmileDirectClub had potential until I saw where they priced it. I wouldn't pay more than $16 for it, which is where it bottomed yesterday, not today. Much more Mad Money ahead. Now that we're finally in back-to-school season, I think it's time to do some homework, a massive amount. First, I'm tackling a sector I get the most calls on, biotech, to see if any under-the-radar plays could be worth considering. Then I'm eyeing under-the-radar chip maker that is a proxy for the trade negotiations with China. I'll tell you if it's worth considering as positive chatter about the talks trickles out, even though you know how I feel. And then all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.